we have these Slauson Spaces monthly. We hope that they are a space where founders, entrepreneurs can come and build connections, ask a couple of questions, primarily because they're tired of Googling and asking ChatGPT for a generic answer. And so this is a chance to talk to real human beings, and get at least one firm's perspective on whatever topic is of interest to you. We try to make these tailored and talk about a certain conversation for the first half or so of the hour. And this morning's conversation is around fundraising strategy, and more specifically, how to approach investors, how to figure out who are the right investors to approach to begin with, and so on. But again, to begin with, we'll quickly introduce ourselves, our firm, and then we'll have a couple of folks introduce themselves. And this is the agenda, a couple of slides to go over. I will try to breeze through them in the effort of having you all ask your questions that you have, and then the second half of the conversation can be around whatever topics are of most relevance to you. And it doesn't have to be fundraising related, but it certainly can if that's still the case. So at to begin with, I'll actually have my colleague Waverly introduce herself, and then I'll introduce myself and a little bit about our firm.
Hi, everyone. Thanks for joining us this morning. I'm Waverly. I am an associate on the investment team with Slauson, so working very closely with Jesus, getting to meet founders and supporting our diligence efforts as we evaluate potential investments. So excited to chat today.
Thank you, Waverly. And on my end, my name is Jesús. I'm a principal with Slauson Co. I've been in venture since about 2018, and with Slauson, it'll be almost 3 years in a few months. As Waverly mentioned, to lead up the majority of our pre-investment efforts, and then post-investment primarily support our founders whenever they're raising their subsequent rounds of financing. On the Slauson Co side, we're an early stage venture capital firm rooted in the notion of economic inclusion. We have 38 portfolio companies. We're deploying capital from our second fund. Our first fund was 75 million. Our second fund, we're fundraising currently, is 100 million. And we lead pre-seed and seed rounds. We also have an accelerator called Friends and Family. I see some of those founders actually joining us for this morning's conversation. So welcome. Always good to have familiar folks in the audience. And we primarily focus on two distinct areas. Our B2B strategy is SMB tech, so tools to support the next generation of small business owners. And then on the consumer side, we focus on companies building products or services that are targeting overlooked demographics and communities. Our name is tied to Los Angeles, Slauson Avenue. That's where our firm is based, and where the majority of our team is based as well, but we're investing across the US. And the ANCO refers to everyone in our ecosystem that we hope to help us in fulfilling whatever the founders' mission is that we've invested in. But to begin this topic of how do I approach investors, there are literally thousands of venture capital firms, which means there are 2 to 3 times that many venture capitalists. And so in a sea of investors, how do you figure out who is the right people, who are the right people, who are the right firms to approach? And so this is how we advise our founders to think about creating your investor list. It's always better to be intentional and thoughtful about how you're building your list versus just scraping some list online. That's not negative, but those people that are able to go the extra mile and thoughtfully curate their outreach of investors, we found it goes a long way, because you're able to prioritize that communication and personalize it as well, and just devote more energy in the right places versus just trying to cast too wide of a net and it doesn't yield positive results. So how to think about even starting the list that you want to curate. You want to think about what stage are they investing at. And again, they're online, it's not always the best way to figure this out. Sometimes a firm just says they're early stage, and this is actually because there's a rise of mega funds or multi-stage funds now. So early stage might literally mean someone invests from pre-seed all the way through IPO. That isn't not helpful for you, but what you really want to try to understand is where are the majority of their investments, where are they making the majority of their investments? Is it seed? Is it Series A? Is it something else? Hopefully you're able to get that from some communications that they have online or their website. But if not, asking their portfolio company founders, et cetera, to try to understand where it is that they say that they're explicitly investing in. The second bullet is around leading deals. And so the reason why we emphasize and prioritize this is because I mentioned there's thousands of investors. A lot of them may be follow-on investors, meaning they might say, hey, I'm interested in what you're doing, but I don't lead rounds. So let me know whenever you have a lead and we'll put in, a smaller check, maybe 10% of the round. While that is not um, unhelpful, that's, money is helpful whenever you're trying to finance an idea and a company. But what ultimately ends up happening, depending on the stage, is you really want somebody who's going to lead a deal. And by that, I mean, they are typically setting the terms, they are investing the majority of the round. And in doing so, because they extend a term sheet, because they are setting the terms, you're able to then use that. And everybody else who said, hey, I'm interested, do you have a lead? With that term sheet, you are able to much more quickly finish fundraising. So you want to understand, do they lead? Do they write term sheets? Because not all investors do. And even when I say extending a term sheet, there's a difference between investors that some might prefer priced rounds, some might prefer safe notes, some might prefer convertible notes. So even an asterisk under lead deals, there might be more nuance around what is the type of deal that they lead. The third point around how active they are. Last year, for those of you who have been following the venture capital space, was a big dip from the 2 years prior in terms of capital deployment and number of deals done. So you want to understand the level of activity that firm is having. And you can just ask, or you can look online if they've published anything about recent deals that they've made. Because what you don't want, and what we've seen and heard of stories of founders speaking to investors that aren't active in the market. And while that is unfortunate for them to be taking conversations, it helps you ask the question of how many investments have you made in the last year, in the last 6 months? How many do you plan on making in the next 6 months, et cetera, just to get a ballpark sense of, okay, they have capital to deploy, they're active, versus they're just taking conversations to understand what's happening in the market. Quickly going through these, but again, please feel free to pause, ask questions, pause me, ask questions. On the fourth bullet, you want to make sure that it's a firm that is large enough to actually lead a round. A quick rule of thumb is if you are raising, let's say, a seed round that's between $2 to $5 million, let's call it, you want somebody who's going to take up the majority of that round. Again, let's say 50% at the minimum. And so you want to understand that their business model is actually writing checks of that size. And so the only way that they're able, generally speaking, the best way that you're able to figure that out is, are they managing enough capital to be writing that large of checks? So what I mean by that is funds that are on the smaller spectrum, 10, 20, $30 million, that sounds like a lot of money, and it is, but their business model, generally speaking, is leading smaller rounds, which is not a negative thing. There's different rounds, but if you're hoping to raise a large round, you're going to be talking to firms that are managing 50, 75, $100+ million in capital, because they are used to and in the business of writing those larger checks. And so it's easier for you to have those conversations than trying to convert somebody who writes smaller checks to write a bigger check, which is out of their norm. So hopefully that's clear. There are other investors that only do specific types of investing. Some people might say, I only do B2B SaaS, or I only do healthcare investments. So you want to understand, are they solely focused on something? And by that same token, the flip side is sometimes firms say, I don't invest in X, Y, or Z. For example, biopharma, or there's certain vice industries, gambling, etc. And so you want to understand, if you're building a company in a certain category, have they explicitly said, I invest in this category, or I don't invest in this category? And if they don't, then you want to not approach them, because it's probably not a great use of your time. On the second to last bullet, this is there's a little bit of nuance here, but generally speaking, investors don't want to invest in a company that's doing something similar to a company that's already in their portfolio. There's just a lot of sensitivity around that. Whenever we talk to a company that's not even directly competitive, but in the same space, we're always upfront with, hey, we're invested in this company. If you still want to connect with us, we're happy to do so. But for full transparency's sake, we have a company in that space. Because the reality is, if taking a quick role of finance in terms of diversification, for the most part, firms want to diversify their portfolio instead of having a large concentration of companies doing the exact same thing. So one is just from a competitive standpoint, not sharing what's happening with one company, between one company to another company, to benefit your portfolio company, but also just from a pure, there's lots of companies that are out there. You don't have to invest in two companies doing the exact same thing, unless that's a super massive market. There's always a few exceptions, but again, generally, investors try to stay away from investing where they already have a company operating in that industry, vertical, etc. And the last point, so again, if you've been able to research all of these different topics and points, you will be able to come up with this list of ideally 100+ investors. But the more that you're able to prioritize them, the better off you'll be, because you will focus the majority of your energy on the first 10, 20, 30 investors, and really try to foster those relationships, those conversations, so that they can yield positive results in the future. But again, hopefully this can help give you a couple of quick guidelines and parameters on how to approach those pieces. I want to do a quick pause here to see if I haven't lost anybody, or if anyone has any questions.
Hey, Jesus, this is great. I just have a general question around what if we do not have opportunity for warm introductions to get to these investors that we think are going to be in our top 10 to 20 of this investor list?
Yeah, sure. Thank you for the segue. That's our next topic. So
I got you. Mind reading.
Exactly. So yes. So one is, you have your list, 100+ firms, but you prioritize it. So you really are excited about connecting with, 20 or 30 of them. How do you reach them? So the reality is, great founders are scrappy and resourceful, and oftentimes they get multiple entry points into a fund. And sometimes we're amazed at how the founders make it happen. Yeah, sometimes I mean, you're in the business of creating something from nothing for the most part. And so founders are just scrappy. These are a list of some of the ideas that we have, that we've seen. There's probably others that we're missing on here. So if folks have some interesting ideas that they're open to sharing with other folks in here, please feel free to share. So on the warm side, just to cover the warm introduction piece, there's a couple of different ways to approach that. So one is, if you have current investors, asking them to make an introduction to you. That's for the most part a pretty safe bet. You're not always going to get 100% yes, again, because maybe they've invested in a competitor that investor doesn't know about, or they're not deploying capital right now. So generally speaking, investors trust other investors as long as the company fits in their high level parameters. There's more nuance around, there's a little bit of nuance in if you're not an investor, and which is the second bullet of other investors, if another investor is sharing a deal with an investor. So, for example, if a company that we pass on for whatever reason asks us to introduce them to another fund, we're not against that, but there's a little bit of sensitivity around how that other investor is going to receive us sharing that deal. Unless there is an explicit reason why we're passing, they're probably going to think, well, why are you sharing with me this deal? Aren't you, if it was exciting enough, wouldn't you be leaning in and digging in and understanding what's happening with the company and potentially investing? So you want to be careful with other investors that aren't on your cap table introducing you, unless there's an easy way, like, hey, we don't invest in consumer, or hey, we don't do pre-seed and they're raising a pre-seed round. So there's ways around it, but just something to be mindful of. I'd say of the majority of these, maybe the third and the fourth bullet are probably the strongest ones in terms of getting that investor to take the conversation. So if a portfolio company founder makes the introduction, that's very strong. Why? Because that firm vetted that founder because they had to in order to make that original investment. And so if you're able to get a founder in their portfolio to introduce you to them, that goes a long way. Because again, it's about trust in the for better or for worse. And so if a founder is vouching for you that they've already vetted, then they'll be inclined to take the conversation. And the fourth bullet is just mutual connections. This doesn't have to be investors or founders, can be other professionals, even personal connections sometimes. I mean, LinkedIn is generally the easiest way and see who you have mutual connections with. So in the event that you don't have these, or you want to double up and make sure that you're reaching the firms, there's the cold intro ways to approach a conversation with an investor. So the first one is direct email. We get hit up often, and we see the emails because we have to, because they're in our inbox, unless for whatever reason they go to our spam. But generally speaking, we actually ask them to submit some information online. It's just and that's actually what Waverly and myself manage. It's just a much easier way to figure out and organize the information of what's coming in. I mean, we get hundreds of companies reaching out and to us, and so it's just not physically feasible to go through hundreds of emails every single day. I mean, there's AI things that we could do, but we want to actually be respectful of people's time. And so we do the second bullet, which is we direct them to a website, our website, where we have a form that we humans actually review, and we actually respond to everybody who reaches out to us. We just ask a couple of different pieces of information that, again, help us make sure that we're going to have a fruitful conversation with them, that they're in the right stages, that we're investing in, et cetera. I see a question, so please, Idris.
Yeah, sure. Hello. One of the things, I'm not sure if it's a trend, but I've noticed that at least on social media, I see more and more venture principals soliciting for, maybe they'll write an article on a topic on AI or whatever the case may be, and then they'll say, hey, if you fall into this category, you think you might be interested, send me an email directly. Is that a more recent trend with the social media, or is it something that has always sort of occurred where principals will actually solicit decks or inbound email if you fall into a certain kind of category?
Yeah, thanks for the question. I wouldn't say it's newer. Maybe more people are doing it now, but people have generally speaking done that. I mean, we don't do it. Well, we do it in the sense of like broad categories. We've done that on our socials as well. Whenever we're interested in a certain area or topic, the caveat that I will say, and I can't speak for every investor, is sometimes those investors need to be figuring out what's happening in the market, where is it with innovation happening. So I say that to say sometimes those investors are doing a landscape analysis of what's happening. So that doesn't mean that they're not going to invest in that category. Sometimes it might mean they are learning about it. And so you just want to be mindful of where that investor is in their journey. They might be posting that because they actually they have a vested interest in making an investment in the immediate future. But the more likely reality is they are wanting to explore that category, that industry, that vertical, and it is in their best interest to talk to as many companies, whether that's explicit or implicit, because the more companies I speak with, the more I gain knowledge about this topic. And I want to figure out who's going to win, why they're going to win, and ultimately invest in them. So if you see that and you're a founder in that category and you reach out to them, realize the obvious that other founders who are also building in that category are probably going to reach out. And again, from an investor perspective, we want to talk to different people that are building so that we are able to educate ourselves in whatever topic or category to make an informed investment decision whenever the time is appropriate. So long-winded answer. So I wouldn't say it's necessarily new. Maybe it's more common now. And again, I'll just temper your expectations to try to understand, why is this investor posting this? Are they just trying to learn about what's happening? Are they actually trying to make an investment in this space? And maybe through some questions, you can try to decipher where they are along that journey, just to be mindful of your time for the most part.
I see. Thank you.
Yeah, thank you. So again, some firms have an ability for you to reach out on their website. We do, and we look at, and if that's an option, then that's always a good one and an easy one. It's an accessible one. The third and fourth bullet, it's a bit of a mixed bag, but we've seen fruitful conversations come from them. So we're now able to do much more in person. And so if you have events that the firm is hosting, or dinners, et cetera, conferences, fintech conferences, et cetera, pitch competitions, they can be great for publicity. Hey, I won this pitch competition, and that could be the impetus to start your cold outreach campaign, because that's impressive. And so and there's a recording, so there's something you can send along with that for people to see. Sometimes different firms or investors or even general newsletters are highlighting different startups. That's another way we get a lot of information from social media, but also different newsletters. So if you're able to be featured or show up on any of those, that's helpful. And then press. Whenever we have our portfolio companies, whenever they're thinking about publicizing that they've raised a round, we want them to be strategic about how they communicate that to the world, not just saying we raise capital and cheer us on, but use it strategically. Are you wanting to attract new investors? Are you wanting to attract potential talent because they know that you have capital to deploy, and they're going to be safer joining your company versus leaving their big tech company, or new customers? So using press as a tool to reach a specific audience is what we generally advise. And so if folks have other ideas of ways to reach out to investors that they've seen and be successful, social media being one that was mentioned, please drop in the chat or share. On other considerations, it's always advisable to share a deck. It makes everyone's life easier. Again, we're able to figure out, hey, this is a space that we have been interested, or this is a space that we aren't invested in for whatever reason. If you can personalize, customize the outreach, say, hey, I saw this company that you invested in. We're similar for XYZ reason. Would love to understand your thoughts on this space, or would love to connect, et cetera. It's a minor thing, but can have an impact on people feeling like you just didn't spam 150 different investors with the same outreach. And again, to this last point I mentioned, we've seen where founders are just scrappy and have multiple points of entry to our firm. And if multiple people that we respect and think highly of are telling us, hey, you need to be talking to this person or this team, we're going to listen, and we're human. And so we're going to be trying to set up that conversation and learn more. I'll pause here, see if there's any questions, comments. Please. Jason.
Hey, Jesús. Yeah, thanks for this. There might be, another section on this, but I was interested in timing. And so I can say specifically for my case, if you already have a, prototype MVP, you're going through the testing, trying to identify exactly who your ICP is. Is it ever too early to reach out if you're currently like bootstrapping, you have runway? Is it ever too early to get in front of investors to say, this is where I'm at, thinking about fundraising later? Or is it like more when there's an immediate need that you are in the process of fundraising? What's kind of like the balance between that?
Yeah, great question. I would say it's never too early. I think you just want to be mindful of what you're trying to get out of that conversation. If you're as early as you think you are, and you are trying to establish a relationship, then don't do an outreach and say, hey, can you talk tomorrow, and like make it seem that this is something that this person has to do. I mean, you want to be respectful of their time as they should be of yours. But in terms of building a relationship, I mean, the earlier the better. And why that is preferred, if you are able to do that, is if you are able to connect with them, they're learning about what you're building. And after that point, you're able to bring them along your journey. What I mean by that is, if they show some interest after that first point of entry, introduction, conversation, if you have an investor or a stakeholder newsletter or update, or you may be on a quarterly basis going forward, you share that with him, they're able to say, oh, wow, like Jason, whenever I first talked to him, he was just had an MVP with a couple of users. Now he's growing and doing X, Y, and Z. Like, something is really moving. He's really able to ship product. He hired this phenomenal person from this whatever relevant company. You're able to bring them along your journey. Additionally, you're also able to ask them. I found that if you have a conversation with an investor whenever you're not fundraising, it's a little bit of a safer space to ask certain questions than it is whenever you're pitching them and saying, invest in me. Do you want to invest in me? Yes or no? One example of that is asking them, hey, can you share a couple of deals that your most recent deals that you did? What got you excited about them? Or some of the vice versa, some of the companies that you recently passed on, why did you pass on them? Or for the companies that you do invest in, what do you have to see in order to make an investment? And you're basically collecting that information, and in one way be able to reverse engineer your fundraise for maybe this specific firm, but also hopefully that's general advice that you can apply and say, hey, I know that this investor really wants to see X, Y, or Z, and I will feel much more confident if I'm going out to fundraise whenever I have X, Y, and Z. Now, if you can't get Z, but you have X and Y, that's better than not knowing what X, Y, or Z even was, or that investors care about that. So if you are able to get intel from investors, and that's easier to do whenever you're not saying, I need you to invest in me, I need a decision by Friday, and you're like, we have to make dozens of decisions, on a daily, weekly basis. More often than not, they are passes, because we can't invest in every single company we see. We invest in about 1% of the companies that we talk to. And so statistically speaking, the likelihood is that they're not going to invest. And so it's actually more advisable to build a relationship earlier on, because even if they end up passing on you for whatever reason, And it might be a legit reason, hey, we don't invest in healthcare, we don't invest in gaming or whatever. They have introductions to other investors, and so that can be in the second category and help you whenever you are actually fundraising. So a bit of a long-winded answer, but yeah, if you are able to, the earlier, the better.
Yeah, super helpful. Thanks.
Yeah. Awesome. Well, so 2 more slides here. So what to include whenever you are doing the cold outreach email, which I think generally speaking is the easiest way to go. People's emails aren't that hard to figure out for the most part, and sometimes they're public. So you can just email them. What you want to do if you do that is make that email as effective as possible and as relevant as possible to them. So some general guidelines, some of these are probably like obvious things to include, but you'd be surprised. Sometimes there aren't included. So website, if your company is public, sometimes it's stealth, so you don't have one. Understanding who is on the team and highlighting their backgrounds, a high level company description, where you are with the company in terms of the product. Are people using it? Are you launching in 3 months? Are you generating $10,000 in monthly recurring revenue, etc.? If you are reaching out to them because you are fundraising, making that explicit to understand the fundraising dynamics. Because again, if you're talking to a fund who leads and you already have a lead, and it's not going to be likely for them to be able to invest for whatever reason, you want to know that up front to, again, be respectful of both parties' time, which is another reason why you would probably want to reach out to them earlier if you're able to. The pitch deck, I would strongly encourage people to put it in a link. Sometimes people still send PDFs. It's not a negative thing, but just from a shareability, it provides a lot of analytics for you, a lot of upsides for just including it in the link. And then I think I saw somebody talk about a Loom video. Yeah, Loom videos are great demos for this email blurb and for any demos. Err on the side of succinctness, 2-3 minutes max. We've seen 10-20 minute videos, and while we start them, we might not be able to finish them because we just get bogged down with other things. We might look at them if we actually are in really going deep into a company, but at the onset, just keep it super high level, and you want to get people excited about what you're building, and you're more likely to do that with a shorter video than a longer video. I'll quickly pause here, see if there's any quick questions. Not, we'll jump to our last slide, which is questions that you can ask investors whenever you are connecting with them that hopefully will make your conversation and data collection more fruitful. Some of these questions I would encourage you to make them your own and ask them. You have to have a little bit of emotional intelligence in terms of like, it's not a checklist, it's a conversation. So hopefully the investors actually will lead with some of this information up front, so you don't have to ask. But if not, you hopefully should feel comfortable to ask it. Why this information is helpful is because it's going to help equip you with your ability to prioritize those investors whenever you are going to fundraise and think, okay, this is a firm that's super aligned, they're active, they lead, etc. So therefore they would come up to the top of your list. Or, hey, this is a firm that I really enjoy talking to, but right now they're fundraising, so they're not going to have capital until 6 months from now, so I got to check back in later. Anyways, it helps you figure out where to put them on your priority list. So the first question goes to one of the topics on a prior slide, is where are they in terms of making new deals? Are they fundraising, which generally speaking, they might be fundraising and still deploying capital, or they might be fundraising and not deploying capital. You want to understand where that is, or they've just finished their fundraise and they have a lot of money to make new investments. And similarly, how active are they? Some firms make 3 investments a year. some firms make 30 investments a year. You want to understand, is it 30 or is it the 3, just so you can adjust your expectations accordingly. You want to ask what their process and timeline is, especially for fundraising, because what can happen is, unless an investor has to make a decision, it's easier for them not to, or it's easier for them to pass and say, hey, look, this is interesting, but I'd love to keep in touch, and please connect with me and check in, once you've launched the product or once you've turned on monetization or whatever have you. And so if you have structured a thoughtful and fundraise process where you are having conversations in a finite amount of time, call it 2 to 3 weeks, and you have the business is in the best position possible for fundraising, and your story is great, your deck is great, your data room is great, then you want to understand, hey, look, I'm fundraising. I would love to understand what your process and timeline is. And so, they might say, hey, look, we have 3 conversations before we get into formal diligence. During diligence, we ask for X, Y, and Z. We meet in person. And our timeline after that, we make an offer, which usually is about 4 to 6 weeks. That's very very relevant to our process for the most part. But you want to understand what that looks like. Sometimes people have 1 3-hour deep dive session in person. And so you just want to understand how you are tracking along their process, what their process is, so that you understand where you're tracking in that process, and how to adjust your expectations and energy accordingly. If a firm is dragging their feet, they're not moving, whatever, that's not a great sign. But maybe that's their process. Somebody might say, hey, look, our process takes 6 months, and they might have their reasons or logic to it. I don't know, but you want to understand that. On the third bullet, this you can ask because you want to know, but I probably wouldn't lead with it. But you want to understand, how do they, outside of the capital, what do they bring to the companies that they work with? How are they adding value outside of the capital? That's actually a question that we ask. What is a company looking for outside of the capital that an investor is providing, to see if with our platform, that's the ANCO part of our name, we are able to add an outsized amount of value than another firm may be. But similarly, you can ask, hey, how do you get involved? Are you active? Are you not active? Because that may or may not align with what you're looking for. Sometimes investors want just capital, and they don't want, or they don't feel like they need any additional support. And sometimes an investor says, hey, I just write the check, I don't get involved, send me a yearly update, and that's it. So you want to figure out which end of the spectrum that firm may or may not be, and then what it is that you're looking for. Excuse me. This next point gets into stuff that we have already covered prior, but what are the average checks? That will tell you would they be able to lead around. You can ask, do they lead? Do they have any target ownerships? Which, if you get some of those numbers, you can back into what valuation ranges are likely from that firm. And then this is the last bullet. Actually, Jason hits your question earlier. If you're speaking to them and you aren't fundraising, it's a great way to ask. This is a great time to ask, hey, what metrics are you looking for from the companies that you invest in? And the reality, whether you like it or not, is that answer may shift over time. So what I mean by that is, 2 years ago, deals were getting done in a very short amount of time. Very early companies were getting funded quickly and with lots of capital. We're now, for better or for worse, seeing the aftermath as of last year, early this year, and probably still for some time going forward. But you want to ask, so now companies that, if the same company was raising in now versus 2 years ago, they probably would have a dramatically different ability to fundraise and amount of fundraising, how long it takes them to fundraise. And so the venture market shifts based upon different things: macroeconomic, is there a recession, is there not, interest rates, is AI hot, is crypto hot, is whatever hot. And so you want to understand, take a temperature check of where is the market right now, and that can help you understand how to best position your fundraise for the future. So that's all we had. Now we'd love to just open it up. Happy to still go on any questions that that are of interest for folks, but yeah, we'd love to just open it up to any questions. I already see some hands, so appreciate that. Justin.
Hey, how we doing, guys? I'm curious around the terms. Is that like a negotiation and it's normally some like rounds of back and forth, or are you guys pretty set in, this is our check amount for like this percentage?
Yeah, appreciate the question. Actually, I have another webinar in an hour about negotiations. I would say you as a founder should have an idea of how much of the company you are willing and able to give up. So you should have an understanding of dilution. I'd say generally speaking, you should assume or expect somewhere between 15 to 25% of the company to be given up if you're taking a venture capital firm's investment. In terms of the negotiation itself, I would caution you and any of our founders, anybody I speak with, to not let that be the first question that you ask. Not that you said it was going to be, but the reality is asking those questions can be a little bit off-putting up front, like, hey, what valuations do you give, or something like that. If you there's ways to go about that. Again, if you ask, hey, what are your average checks and do you have target ownership? You put those two numbers together, you're able to figure that out really quickly. If that's not aligned with what you're looking for, it's good for you to know, or maybe that's not ideal, but there's a reason why they have those valuation ranges, and you want to understand, hey, maybe I'm missing something here. Maybe they are actually this capital, while it might not be the cheapest, i.e., I might get a high valuation from another firm. Actually, I'm really aligned with what they're doing, and I feel like they can really be additive to my journey and the company's journey. The other piece that I will say, especially like 3 years ago, we saw a lot of founders what's called self-pricing. So they're saying, hey, I'm raising 1.5 at a $15 million valuation, so 10% of the round. Like, are you in or are you not? Like, that's kudos to them and their confidence. However, what you're saying is that I am putting a price tag on my company, but the founders, you as a founder, typically you're only going to have one data point, your company, maybe sometimes a couple others, your founder friends, if you have a few, maybe that have fundraised successfully. What we have is we have dozens and hundreds of other data points. Like, oh, hey, and we have to compare and contrast a company that's post-product, post-revenue, generating 10K MRR, that is not self-pricing, versus somebody who is pre-product, pre-revenue, but the founder thinks that they deserve or merit a certain valuation. Not to say that they don't, but in a world where we have more data, because we're talking to companies constantly and seeing deals, we have more data of what the value of companies, the price of companies at different stages is more than that a founder would have. So that's one point of caution there. Just be very mindful that if you are going to be self-pricing, which is not something that we advise our founders, but it's something that founders do. If you're going to go that route, try to get as much data from investors and founders, which again can be a touchy topic. If you ask another founder, hey, what did you raise at? How much did you raise at? If you have those founder friends, that's great, but just be mindful that if you are going down that route, you have a lot of data points. The last thing I'll say on your question, Justin, is what you really want to figure out is this firm interested in what I'm building or not? If the firm is interested in leaning in and doing diligence and asking thoughtful questions and asking for references and so on, and if they make an offer and for whatever reason it's not one that you were excited about, it's a conversation. I mean, you can call it a negotiation, but if they've done all of that work to understand what you're doing, what you're building, it's not likely that they will want to lose a deal for certain reasons. And so hopefully there's some flexibility on yours and their end, and it can be some sort of compromise. But you want to figure that out after you know that there's some explicit interest in the company and you.
Mhm. Got it. Thank you.
Yeah, thank you. Yes, Idris.
So I have a two-part question. One, I'm sort of I at a point where I'm sort of resigning myself to waiting to trying to do an institutional raise after I've established product market fit, and I have some level of clear traction, objective traction. So the first question is that a common approach that you're seeing sort of like at the pre-seed, sort of seed stage companies? And then two, one thing that I'm also starting to consider more seriously is crowdsource funding as a means of getting some of that initial capital as well. And so the second question is, what is your view in terms of how do institutional investors view, companies, raising crowdfunding and then also looking to still raise institutionally as well?
Yes, thank you for the question. On the crowdfunding question, I would say we don't necessarily view it as negative per se. I guess the question that would probably indirectly or directly are going through people's heads is, why did they do that? Sometimes there's a legitimate, like if you're a CPG company, like there's a ton of upside to doing a crowdfunding campaign. You get marketing exposure, you get your customers to be investors in your company. So sometimes there's legitimate reasons why it makes a ton of sense to do it. Is it a red flag now? I would say no. Maybe 5+ years ago, it was more of like kind of a niche fringe thing to do. That said, it's super time intensive and not cheap for a founder to do, to my knowledge. And so from a founder's perspective, you have to weigh the pros and the cons of going down that route. I think it's multiple months, and I don't know what the average crowdfunding campaign yields. So it's more of a personal question of, do I want to do that, or do I think I will have better results just raising an institution around from the get-go? So that's more of a, where do I want to put my time and energy into. On the gosh, what was your first question again? I had an answer.
No, the first question was product, waiting until after product market fit traction to really ramp up sort of institutional engagement in terms of capital.
Thank you. So what I will say is fundraising is half art, half science, and some people, and that's on average. Some people it's all art, some people it's all science. By science, I mean like they're looking for product market fit. They're going to ask about CAC. They're going to expect churn numbers that are vetted, that you have year-over-year growth. And some people are like, hey, I want to understand what does this become in 5 to 10 years. Yeah. So what you can control, or sorry, what I will say from whenever we're evaluating companies, again, on a daily basis, dozens of companies, we want to understand capital efficiency. So what I mean by that is, in this current market, we're seeing companies raising new rounds of capital. But in addition to that, we're seeing a lot of companies raising bridges or extensions, which is a different category of a fundraise. That just means that for the most part, either they didn't raise enough to begin with to get them to where they need to get to, or they legitimately need additional capital because of a new partnership or of a new pivot, et cetera. That's a second category. And then a third category is down or flat rounds. So a down or a flat round being a company that raised at a $25 million valuation a year ago in April and are now raising at a $12 million round because they don't have the metrics that would justify that valuation, or a flat round at the same valuation. And so I say that to say, whenever we're talking and looking at those decks and having those conversations, what it comes down to is capital efficiency. So if a company that's raised $6 million at a 20, at the latest valuation was 25 million, and they have, $100,000 in ARR, but then I'm looking at it and they're trying to raise, call it a down round or a flat round, but then I'm looking at another company that has raised $500,000 and they're generating 60K MRR, and they've been around for less time than that other company, like, and that company, you would categorize it like they're looking for some valuation in the $8 to $14 million range. So we're putting both in the same category. An investor would probably be more interested in having in looking at that second company because they're scrappy, they move fast, they are, again, capital efficiency. And I'm not saying that that's always how an investor is going to look at it, but an investor is going to care about, when did you start building this? What are the resources that you've had available to build this, and then where you are with it, and they'll adjust accordingly. If you have a ton of resources, more will be expected. If you haven't had as much resources, but you've been able to prove and build something that should speak to them around, if I had more, aka your capital, coming in, I'm going to do a whole lot more with this. So hopefully that's a little bit more nuance, but yeah.
Thank you.
I know we have time for maybe one more question if you have it. Thanks for folks being active on the chat. Yeah, Jason.
Thanks. This might be on the art side, but you also mentioned just having a tight story. And yeah, I was just wondering if you had any like resources or tips on things that you've seen from companies you've invested in where you were like, oh, this story is tight. This was really strong. This was a good like lead in that got me really interested. I know that's kind of a broad question, but yeah, any kind of guidance on that would be really appreciated.
Yeah, a couple of things that I'll say. So one, practice makes progress. So if you are able to practice, like anyone who could literally give you 3 minutes, like listen to your pitch. What did you think? What was confusing? So practice. Second one is, for better or for worse, investors like analogous things. So the 401k of X, the Uber of Y, the Airbnb of is X, Y, or Z. Like if you can draw some parallels, that should be helpful. And then the third piece is, you might benefit, not you, Jason, but like any founder might benefit from, I wouldn't necessarily say a pitch coach, but maybe just more of a coach, in terms of professional speaking or what have you. That's one of the things that actually our friends and family companies just had last week. They had a consultant come in who has deep expertise in fundraising, and she literally like dissected people's one-line pitch, and like that's all they focused on for an entire hour, sort of a workshop. So sometimes you could benefit from that. And in terms of the story, yeah, you will get better at it. It doesn't get easier because the story will evolve as the company progresses. The story will evolve. You need to figure out, do I emphasize more of the team at first? Do I emphasize more of the market at first, the product after you've launched, et cetera? So you have to be a little bit flexible. And then you also want to be able to tell it in different forms. Like, I need a 30-second version, I need a 5-minute version, and I need like a 1-hour version. Because you want to adjust to the time that you have with those investors or customers, et cetera. Because as a founder, you're selling all the time. You're selling to get investors, you're selling to get customers, you're selling to get employees. And you need to instill in us that the confidence that you know how to sell. And again, practice, sometimes some professional support should work. I know we're over time, but it was a pleasure having you all with us this morning. Hopefully this was valuable. This is a recording, so it will be on our YouTube if you ever want to reference it back. But yeah, we do these once a month. I hope everyone has a wonderful Tuesday and rest of your week.